Good morning, everybody. Welcome to the Flow Show. It's finally Fed Day. Here we are, ready to do battle with the central banks. Morning, Kay. Morning, Stel.
Good morning. We're fed up today.
You've been saving that one for ages, haven't you?
You know it. How are you, mate?
I'm all good, mate. I'm all good. I've been running around a bit this morning. The kids are off school because of the poxy teachers strike. So I'm trader, teacher, kitchen cleaner, breakfast maker, everything going on. So yeah, all fun and games. How about you?
All good. Getting ready for the my upcoming London trip, but all good. Yeah.
Yeah, I'm going to be sorting out a venue for that actually today.
Okay.
So yeah, we'll tell you what alleyway we're falling about in.
Absolutely fine.
Come and join us.
Looking forward to that.
Yeah. Right. Kay, you about?
Morning, lads.
There he is. Back on the saddle. Right. Let's get cracking because no doubt you boys and girls are going to want to know everything that's going to go on today. Let's have a little look at the data to kick off with because it's PMI day and a lot of data out this morning and around everywhere else. First, we'll take just a little look back at some of yesterday's data. Canadian GDP missed year on year 2.8% versus 3.5% expected. The monthly number came in line. There was a bit of a market mover from the Q4 employment cost index numbers, which came in at a miss down, 1%. It missed by a pip. And they actually got a bit of reaction in the dollar. I don't think I've ever seen this number move the market like that. But the market perhaps lacking a bit of liquidity, traders sitting on their hands awaiting the Fed. And this data put a little bit of bearishness into proceedings. And we saw quite a move in the dollar over that. House prices in the US edging down still. 8.2% versus 9.8% from the FHFA there, and the Case-Shiller numbers also coming down. The 20 city numbers 6.8% versus 8.7% the prior. Chicago PMI, another soft number there. US consumer confidence a miss as well, coming in at 107.9 versus 109 expected. That all important inflation number as well. It actually went up to 6.8% versus a prime revised 6.6% on the 1 year number. So expectations there not following the actual CPI in this month anyway. Overnight, some Kiwi data, employment data there, and also some cost index numbers there. Roundabout as expected, 4.3% uptick on the 3.8% seen in the prior quarter. So still some wage pressures coming in there. The unemployment rate ticked up a touch to 3.4% versus 3.3% expected and prior. Manufacturing PMI from Australia, there you can see just moving into expansion, beating the 49.8 prior, but still down on the prior month. Coming over to today and more PMIs. Here we go. So Japan coming in as expected, no change there for their reading on that one. China as well, a bit softer, matching the prior month, but it didn't tick up somewhat. Again, we may see these numbers picking up in the next couple of months as all the reopening kicks into place as well. There's where am I going? Down here to next PMIs. Spain manufacturing, they're up 4 pips, so better than expected there. Swiss had a little bit of a wonky one there, falling quite steeply into contraction. Coming back to some of these are the final numbers from Europe. Italy, a decent jump there into expansion. France, a little bit softer, but still in expansion. Germany ticking up again, but still in contraction. And look at good old Greece, go for it there. 49.2 versus 47.2 prior.
Come on.
boom times in Greece. And the pound euro number coming in the flash, same as the flash on the final number, 48.8. Lastly, over to the UK, and again, another little bit of a tick up over the flash number, but still well into contraction there. Then we got Eurozone CPI, the core number, probably most importantly. It didn't rise as was expected. It matched last month, so could be seen in softer terms, that it wasn't rising as expected. But as you can see, another steep drop for the headline number, 8.5, 5 pips off what was expected and 7 pips down over last month. So maybe a little bit of disparity again between the headline numbers and the core numbers. Obviously, the trend is still lower for inflation overall, but that core just being a little bit stubborn, and that's likely to get the market thinking about that going into the ECB tomorrow. Just a quick look at the data to come before the Fed today. We'll keep an eye on the NBA data. Has been posting positive numbers in the first couple of weeks of the year. Could be just some new year pickup, so we'll keep an eye on that. And ADP is dropping today as well, our first precursor before the NFP. 178k is expected there. I will have the NFP competition post up before the ADP. I'll be doing that just after the flow show today, so keep an eye on for the competition, where one of three lucky winners can each win a free month on the ForexAnalytix platform if you get closest to the number. For the rest of the data, we've got more PMI action, the big ISM coming ahead of or after the S&P numbers there. JOLTS as well. These are a bit behind, but the market will look at that, and the market's going to have their last minute pricing and jiggling around on these numbers for expectations going into the Fed. Again, perhaps we've got a little bit of lower liquidity with a lot of players staying out. So be wary that some of these numbers could move the market a bit more than usual if there's large variations in them. That's all what we got coming up today, and the historical stuff from yesterday. So let's get into a few of the headlines. Chinese President Xi said that they need to coordinate expansion of domestic demand with deepening supply side structural reforms. That was speaking to state media. Over in Japan, why this has been reported, I don't know, and I'm not sure the context, but apparently board member Tamura is to deliver a speech and hold a news conference on February the 22nd. On a quick look, I couldn't find what the speech is about. I checked the Bank of Japan calendar. They are releasing their year-end financial report for 2022 and a few other bits and pieces. So maybe it's related to that. I don't know if you've heard anything about that, Kay, or have any idea.
No, not at all, man. Zero zip. I don't know what it is about.
Yeah, so it could be nothing. It could be something. Who knows? But stick that on your post-it pad anyway, Feb 22nd. Over to Australia, and the head of economic analysis at the RBA said we believe the peak of inflation was in Q4. If you remember, we did get a bit of a jump in inflation at the last print, maybe a bit of a surprise jump there, but certainly this fella Kohler is calling a peak in there. RBA not one to be right much on any of their calls historically. Those that may not remember, 2021, they were saying that rates wouldn't go up till at least 2024, and see how long that lasted. French unions are planning new strikes and demonstrations against pension reforms between February.
What, really? Strikes?
Yep.
Come on.
Strikes in France. You'd never heard of them. Never heard of them. I've only highlighted it because these things are still bubbling under the surface. Been banging on about the UK strikes going on. As I say, even today there's a teacher strikes. My kids are off school, probably today and tomorrow, and then again in March. And when the French start protesting and going on strike, it's a big deal in France. So that's happening there, 7th to 11th of February, so 4 days there. That's it. That's all I've got this morning. Unless you guys have got anything you want to throw in.
I have couple of things to say.
Couple. We're blessed.
Regarding the employment cost index that moved markets yesterday, it was surprising, like you said. My commentary on that is that I think we can all kind of agree that inflation is not going higher from here. It is going to be dripping lower. I personally think that for the US is going to be dropping quite fast. But anyway, I guess what the markets are trying to tell us is that the big issue now is what are the second round effects, because when you do see employment costs, so basically the cost of labor going up, that's going to have a secondary effect in inflation for sure, because the more money you earn, the more you spend, etc., etc. So that is slowly the interest is kind of transferring to that now, or should I say it otherwise? It's becoming more important than it used to be. So that's my view on that. I was actually surprised with the move, because the market jumped right when the number was out, and I'm like, what's happening? We don't have any numbers now, but that was the one. And the other thing which I wanted to say, I've forgotten actually. What was it?
Yeah, two things, mate.
Yeah, two things. One more thing, I forget stuff. Actually, yeah, CPI, Eurozone CPI. You mentioned it came in quite a bit lower than expected. The core was steady. That came also lower than expected. It's strange because German CPI we saw is very sticky, so I can only assume that the periphery is dropping fast, and I didn't expect that. I thought that inflation in the Eurozone is going to be a lot stickier than, say, the US. I mean, it is actually. It's dropping at a slower pace, but it's still dropping faster than expected. So I'm actually surprised that the markets didn't move on the back of that number. I mean, euro pound, euro dollar are practically unchanged on that. Same with equities, same with metals. I mean, metals usually move on inflation prints. So I'm a bit stumped by that, but I guess the reason might be because we did have a lower print in CPI, but a relatively stubborn print on core. Yeah, but otherwise everything's going to pale into insignificance as we go into the Fed today.
Yeah.
I thought,
and one thing I want to highlight on that employment cost index as well, and this was picked up by Carl Quintanilla yesterday, is what Brainard said back on Jan 19th, talking about this very data point, saying that there are tentative signs that wage growth is moderating, and that she'll be watching to see whether the employment cost index at the end of this month showed deceleration from the third quarter continuing into the fourth quarter. Obviously, Brainard, a bit of a bigwig at the Fed, has this data point influenced her thinking for what rates should do going forward? That if you're in the market, we're keeping an eye on that comment there previously. That may be why we saw such a reaction in the dollar. But an interesting pick up there from Carl. Sorry, Kay, was you chipping in?
No, I thought Stel was going to mention the cheesy Swiss PMI that he commented about.
No, I didn't actually.
I was trying to front run you still, but too late.
Well, I didn't mention it, so there you go.
Yeah. By the way, on this Bank of Japan board member Tamura, he is one of the sorry, he or she, Naoki, could be a she.
It's a he.
Is he?
Yeah.
All right. Yeah. He's one of the people in charge of the review of the bank's monetary policy framework. So it might be, it's likely going to have to do with that. And perhaps by that time, we will know who the nominees are anyway for the replacement of Kuroda. So it's probably worth penciling this date in February 22nd.
Yeah, he was one of the two newbies that got put in last summer, I think. There was the other guy, Takoshi might have been. There were two guys who came in at the same
Takeshi's
time.
Castle.
New members, yes, 2 new members last year. He was Tamura was one of those. So he hasn't been in the seat too long. But anyway, it's that's for later in February, and we got plenty more to talk about until then. Right. So what's happening in prices? Not a lot, to be honest. We're wandering about. We are moving about. As you can see, yesterday we got moved down early morning. Might have been some last month in stuff rolling through. Touched the low. Just managed to nick near that 108 level, and boing, we've bounced all the way back up, and now we're possibly going to test 109. It's been a similar pattern in a lot of pairs, walking from the ranges again. Cable, a little look under 123, back above again today. Again, not really doing an awful lot. I've seen a few comments coming out, and you know, some traders looking at the moves. Oh, the dollar was off yesterday, then it's stronger today, yesterday afternoon, weaker, and a lot of people are trying to read things into these moves going into the Fed. And I think you've got to be careful. We've said it all before. Liquidity can drop in these periods. No one wants to go out on a limb on any trades going into these big events. But the markets are like sharks, okay? They don't stop moving. They're always going to move. There's always every little flick and tick you can see there is a trade being done. Markets will move, but you've got to look at the ranges and trade the edges, like we've been saying all week. If you want to trade the edges, trade the ranges. Don't piss around in the middle and end up getting caught offside on a trade, running into the Fed, and you don't know what to do with it. You know, Aussie dollar, case in point. We got down to the 70 level, actually got under the 70 level, and I came within a whisper of getting stopped out of a long at 7006. Fortunately, this time I didn't get knocked out. Now I'm sitting in a position that's, you know, 60, 70 pips on side. I've taken some profit. I've locked my stops in. I've got some margin to play with if I want to hold this trade over the Fed. I've got some room to maneuver. I should have enough time if the trade goes against me over the Fed to either get out, or I've locked my stop in even further into profit. It's a no-lose trade. Dollar CAD making a bit of a fist down at this 130 level. You know, again, it's been a pretty solid level going back, and here we are again. It's holding. We had a little nick under, but largely it's holding. Am I going to trade it now into the Fed? No, not at all. But if you're thinking about a level, if you want to be long off of here, wait until after the Fed. If the Fed gives something to you, you might get a better level. You might get a move down here if they're a bit less hawkish than expected. I would have liked to have seen a move up to 135 yesterday for a little scalp off a decent level, but we never got that high. You know, that might have been a decent trade, but you know, we can't trade backwards. It is what it is. Kay, how are you setting up? Are you looking to scale down any positions into the Fed, or you're just getting ready to pick your points to hit the buttons over it?
Yeah, I'm traveling extremely light. I did have a counter trade on in dollar CAD on the fixing yesterday, because the Canada really strengthened a lot on the fixing, and that exploded right in my face. So I took it off this morning. Yeah, it's holding. I've got a bit of a trend line coming in there. We briefly went below it. We went down to 132.88 or so in the dollar CAD, but it seems to start to hold again. So there's probably a very tight trade perhaps to be had, and I'm actually contemplating it, and it's only a 20-25 point risk trade over there. Maybe I'll re-enter and just see if we can get a little bit of a pushback ahead of the FOMC. But no, in general, I'm traveling extremely light. I have my core euro sterling long. I have my long-term silver, and for the rest, it's just a bit of a jobbing mode until the FOMC. We have the Come on, help me. The ADP out, and then manufacturing PMI out later, construction spending, yields. There's still a lot going on before the FOMC comes out, so stuff could be a little bit on the move. No, for the rest, I'm traveling extremely light. We're as we've been mentioning already a few times. We are just in front of very important levels on a couple of pairs, like the euro dollar above 109. Cable has shied away now because of the euro sterling pulling up a little bit, but up in those 124s. Aussie not too far away either. So we're ahead of like important enough levels to see what's going to come out of the FOMC and see if we get a break or failures or see what there is to do. I'm not really want to rush in too much stuff right now anyway.
No, I agree, mate.
Here, no, I'm long silver from the Stone Age, my friend. I've been long silver for I don't know, a year or two now.
Me and you, mate.
I'm trading it in and out.
Yep.
And around my core longs, surprisingly, it doesn't cost much, if anything, in funding. I thought being a retailer, I would get hammered on the funding, but apparently, it doesn't really cost much at all. So that thing is in the long term. I think sooner or later it's going to explode. But let's see what goes on. In the meantime, I'm out of the woods. I'm not saying it could fall to zero, but my average is pretty cool. For the rest, I don't know, mate. I'm on the, as people know in the room, and I've been talking about here already a few times. My actually main focus and my biggest position, because I've got an option as well, is the euro sterling, and I'm very, very interested to see where ECB and Bank of England could be diverging and taking euro sterling up to 90 perhaps. My magic level is still just above that 89.10, where you have your yellow line there, the 0.5. That's my magic level. We stopped right in front of it already a couple of times. And if that goes, that's really the gateway to 90 and perhaps a bit above.
Yeah, definitely. I agree, mate. Right, I'll give you boys and girls a little heads up. This is usually information that's just for our subscribers, but if you're watching euro dollar, we've got some sizable expiries today. There's 1.5 billion going off 108.70.80 and 2.43 billion going off 109.0010. So that might keep the price pretty close if there's any last minute hedging to be done around that level. Again, maybe liquidity is a bit lower, so it's going to take less to move the price around. But if we see us holding around here, the options might be having a bit of a magnet effect on it. Otherwise, as mentioned, today is really, for me, these big events, it's really just about plotting my levels. Where am I happy to trade? Aussie dollar is obviously one that I'm long, call long. I'm looking at the levels. Will we get the breaks? Will the big levels hold? In this one, and these levels we've been speaking about long and often. So this is nothing new, but this is what we tend to look at. This level up here, 71, 30, 40. We're 60, 70 pips away from it. It's in range. If the Fed is a bit middle of the road, reiterating their case of rates going higher and keeping them for longer, if the dollar appreciates, we can have a look down here. We're 70, 80 pips away from the 70 handle again and these prior lows. If we get down there, test there on that news, can't break it, that tells you we're likely to stay in range. And then, that's when you look at longs. Conversely, if they're not as hawkish as expected and we get up here to this area and we can't break it, we might still get a little spike through, but if it doesn't last and we come back under, then that's where you want to be looking perhaps for shorts, because there's no game-changing news coming in. Trade the ranges. And there's plenty of these going around. Here we go. Dollar yen with a 129 handle. It's either 129 or 130 for the last 2 weeks. And that's really not going to change unless we get some big news. So, but again, look at your big stretch points. Am I going to trade the Fed in this noise here? No. I might trade it if we get to 131s, this area here. I might trade it if we get to 133s up here. I might trade it if we get to 127s. It's all about doing your homework today. Go through your charts, pick your levels, then score your levels. Which ones are likely to have an effect. Nothing within 50 to maybe 100 pips is likely to be bothered about if we get some big moves. It's going to be the bigger levels down here, maybe into the 128s even. Those are the areas you want to be looking at for any reasonably sized news. The rest is just going to be noise. One pair that I am keeping a close eye on, because I've already been short this one since last October, and we're having a move back up. The dollar Hong Kong. Now, you may or may not know, most of you will know, it's got a band that it stays between 7.85 up top, 7.75 below. I was short up here since last October. Managed to knock some off all the way down here. Didn't quite get my 76s to get out the trade and then start looking for longs. So be it, but we're getting up towards the top here. There's not many trades you can get a central bank watching your back and who's got your back covered. A lot of people have tried positioning for a break and they've held on. Doesn't mean it'll last forever, but for now, I'm happy to risk it. Low risk trade, 150, 200 pip stop on top. And if we hit our heads on here, you can just sit in it like I did and then wait for the move to happen if it comes along. So this one's getting close to going back up. As I say, keep an eye on that one. Dollar one, you guys and girls know we trade it quite often here. It's not doing an awful lot. Even everything that's going on elsewhere, what's happening in China, reopening, coming off the holidays, it's very, very still, which is a bit concerning. Well, I wouldn't say concerning, but it has the feel that maybe there's an official hand keeping things smooth for the moment, i.e. not letting it go anywhere. We've not had any recent comments about the currency from officials in China, whether it's too weak, too strong, whatever. So again, maybe a bit of range trading here. Longs into the 671.70 still valid. A break above 79.80 is possibly a runner up to 84. What are your thoughts on the 1K? Not really doing a lot, which is
very quiet, very, very quiet, and very quiet. Even coming out of their holiday week, we haven't really heard much about the officials that would be moving stuff. They seem to be going quite steady. I haven't read too much news. There's some stuff going on about lending programs, but not really any breaking news or any big headlines out of the official dom in China. No. So yeah, it's on the radar as usual. I might try to, if the dollar takes another knock on the head, anywhere between 670 and 660, I'm going to be quite interested to go long in that stuff.
Yeah, cool. Cheers, mate. Stel, you got anything you're setting up for today in particular? Any market moves since the last couple of shows that have changed your mind on anything?
Not really. The question is I'm running very little into it. The question is what we do with the reaction. And there's a question from one of our friends here, and it's something a lot of people ask is, what do you think we do with the reaction? Because last few times the Fed has been a little bit more hawkish than expected. The market moves and then bam, it's faded and we go the other way. So what happens is hawkish Fed, risk off dollar rallies, and then after a few hours or a few minutes or a day, it all gets reversed. So I have a feeling this might be the same if they are hawkish. But as I said before, I don't think they have reasons to disturb the markets here. So unfortunately, I think it's going to be a dud going into the Fed today. I hope I'm wrong. We like a bit of volatility. But to answer your question, I don't have much running. No, I just have my silver and just waiting for levels, really. So nothing's quite there at the moment.
Yeah, and I assume that was that question from Brian saying is whether tomorrow's spike should be faded in the dollar.
Yeah,
it's, you know, for me, it always comes down to the levels. Okay, if we get a decent move and we've got levels in play, does it break the levels or not? And if it breaks the levels, does it hold the break? And that's how I plan my trading. So, you know, price can go through a level, but can it hold the level for more than 5 minutes? If it can't, then we're likely to go back in the box. And so that's when you try to fade the move. Now, what we've got with this week in particular is we've got the risk of the NFP on Friday. You know, we could have a situation where the Fed's reasonably hawkish, dollar rallies. Everyone thinks, yep, here we go. Dollar's going up again. You know, euro's going back down to 105 and cable's going back down to 120, blah, 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 blah. And on Friday, we get a negative 300K NFP. That's going to turn everything on its head. So, you know, it's not just a case this week that we have the Fed and then we don't have to worry for a couple of weeks. We run into some more big data. And that is big data that can change the game. You know, we could have a situation, dollar yen, we get a hawkish Fed and we run all the way up to 131, all the way up to 133. You know, don't break that. I'll be looking at adding to my short position. Coming Friday, we get an NFP down 200K, 300K, and we go all the way down to 127 and I hit my bottom level and I get out my shorts and I pile into a few longs. You know, that's all you can do. You've got to take each event as it comes. And unless we break the big levels and hold the breaks of the big levels, we stay in ranges. And while we stay in ranges, it gives you the perfect places to trade. You know, if you want to mess around in the middle, be my guest. For me, I'm going to pick my levels, do my homework, say I'm going to trade that one, I'm not going to trade that one, I'm going to trade that one, I'm not going to trade that one. And I have my list, be it in my head or on my charts, what levels I'm prepared to trade. And if the price gets there, I assess it, I trade it or I don't trade it. And if I end up doing nothing, I end up doing nothing. So be it. Then I'll move on to the next thing. But I don't want people to think with all these big events, they've got to make pips out of it. They've got to capture all the moves. They've got to be ready and ahead of it. They don't want to miss a big move. If you miss it, you miss it. You come in the next day and you go again and you look at your levels and you wait and you have your patience. Don't think you're ever going to miss something, a big move, because you don't know what to do or you're not sure. Because that's the way you lose money. You get too excited. Oh, I think the Fed is going to do this, so I'm going to buy or sell that, and you're just punting. You know, you don't know what the Fed's going to do. I don't know what the Fed's going to do. Kay doesn't know, still doesn't know. We have ideas and views, but at the end of the day, we'll trade what the market does, not what our views say. And if we're right, fine, we come in and go, woo, look, I was right about that. But at the end of the day, the price action is going to tell us whether to trade or not. And that's the best thing, the best advice I can give you. Kay, you've had your day to get your colouring pencils out and go over your charts. Do you want to show us a few?
Yeah, sure, mate. Sure. Let me see what we can talk about today. And yeah, as you were saying, about the where's my screen here? Okay, let's just go to the euro dollar first. As you were saying, yeah, about the Fed, whether it be hawkish or dovish, Stel said something really correct in our chat room this morning, saying
for once, yeah.
It's a bit worrying that we are all thinking the same thing, that the Fed should be hawkish because of the financial conditions weakening so fast. And it's actually my base case as well. My base view is that not especially on the interest rates. Well, 50 would be a surprise. So 25 is baked into the cake, and 50 should be the surprise. And but then is it going to be a hawkish surprise or a dovish surprise? It could go 50 and say, okay, we're done. But I personally think that Powell will be, or let's say the FOMC will be hawkish. They don't like those financial conditions to loosen that much in such a short time. That they will be, and he might actually guide the market a little bit more towards saying like, hey, we are not done, and we are going to go to that 5%, and even perhaps 5.10, 5.12.5 mid-rate. But what could be the kicker is that today is that they changed something on the QT just to try to tighten the financial conditions and to force people to put the money that they have in the reserves, to put them more at work, because the RRP is still overflowing with cash. So that would then put a bit of topside on the yields likely. And we can't forget it's FOMC, so everything is turning around, but we can't forget that there's something bubbling under the water, and that's the debt limit. And Yellen already said that they may stop issuing treasury bills soon, which is actually putting a little bit of downward pressure on the yields if you just take that one standalone. So the Fed knows that. The Fed knows about the debt limit as well. So there may be some sort of action this night to try and keep the yields high. Will it last for long? The reaction in the market is still the question, right? That is still going to be the one thing that we need to watch out for after the initial reaction has already been set here a couple of times. So we know we are hanging around that important level, depending on who's looking at which high here. It's 109, 109.40. Those 40 pips, we're very close. We're trading 108.90. Those 40 pips are really where we should be taking off or hold back and continue to trade the range. If you look at the shorter term, this 107.70 is already looks big enough to it's been holding there a couple of times now in that zone. So watch this 107.70, 107.60.70. That's the downside I'm going to be monitoring to see if we get down there, if they are a bit hawkish and then start to bounce again, or we can have a deeper retracement, which could lead us down to 105.80 or so. That would be a reasonable target if they're really hawkish, and the market needs to rethink a bit its stance on the dollar in the immediate future. Cable, I'm not going to cable. It's still there, right? This one, call it 124 now, 40.50. That's going to be the main level there. And on the downside, anywhere 122.60, 122.50, 60 is going to be the level that I'm going to monitor on the downside. Cable is a little under the cush compared to the euro dollar because of this euro sterling starting to climb higher again. And thanks, Gav. I just stolen your trend line here. For the really short term, there should be a little bit of offers, I think, starting around here between 45 and 60 on the euro sterling. I've got my call right there at 88.5. I might just ahead of the ECB, and I've still got some cash longs as well. Just take a little bit off of the cash, and then let the option do its work. If I get what I want, and that's more divergence between the ECB and the Bank of England. Perhaps not in the actual interest rate moves, but in the wording and the how they are planning to handle the whole situation. The UK economy looks a little bit more fragile to me right here and now than the European one. So yeah, I'll be looking at over the ECB, Bank of England at a move higher. my magic level is still here, 89, 10, 20. That's going to be the zone to break and the gateway for 90. Back to tonight's FOMC. Dollar yen, it's tightening the range. So for those watching really the closest levels is 129.70, 130.5 perhaps, but I think we should widen it out a little bit to because the FOMC is big enough to make things move a little more, of course. So keep a first eye on 129.40, I'd say, and then 128.85, 90. Those are going to actually, this one is one that I'm going to be looking at because it's a bit of a traffic zone from the past as well. And if we if the Fed is really hawkish, we should be paying attention to what's happening in the 131, 40, 60 zone. If that goes, then we could have a look at 133, as Ryan was already saying. And if they are really hawkish and make the market rethink their strategy about yields, that is going to probably or possibly trigger a move back to 134.5, which is that is really a big zone in my opinion here. If ever dollar yen reaches back this 134.5 area, look where it closes, because it could be moving a lot higher if we start to break above here. But that's really not what the market is telling us, and not what the yields are telling us either. Right now, and dollar yen is back firmly onto the yields train right now. So that for those currencies, I'm going to let Ryan, if he wants to talk about the Aussie, because you have the position. I agree with the 70 level on the Aussie. But then there's an interesting development here on the Kiwi, because we are trading 68.40 right now. We have been rejecting these moves above 65 pretty hard every time we went up there. It's coming off really fast. If you look at them, we're going up there, bang, going up there, refusal. So anywhere between 65 and 65.30, if the Kiwi would make it up there, post FOMC, pay close attention to what's happening here, because if this really breaks, then I don't see much for another two big figures in the Kiwi, two and a half big figures really in the Kiwi. If 65.30 would give way. On the downside, well, it's there, right? 63.90, 64.10. If that starts to break down, then we could have a move lower. But I don't think the market is really in the mood to buy a lot of dollars on every special occasion that we have. But that could be somewhere the surprise if Powell and friends really go very hawkish on the financial conditions. So it's not only about the interest rate tonight. We have to keep the thing in the whole thing in mind. And then, of course, as already mentioned, we have to be mindful that on Friday we have that NFP report, plus the revisions of 2022, which to me could be a bigger move than the actual NFP report. But we'll talk about that later. Interesting one. The NOK got a real knock on the head into month end. It got really smacked, and so dollar Norway went back into this resistance zone that I've been talking about already a couple of times, but refused it again. And now we are looking back at these low 990s. That would be the first level of interest, in my opinion, going into the FOMC. For those who want to trade Scandies, be careful. They are very volatile at times, and you won't only trade dollar NOK, but you will also trade risk and Brent. So you could have like a bit of saloon door or double whammies in those things. The big levels are still here around 978 and then the 970. But the rejection up here is pretty telling, in my opinion. If it would start to break, then I'd say be careful, because that would mean that, as I was already saying, the market needs to rethink its position on the dollar. and risk will probably get sold off. What else? Dollar mix. I don't have much to say. You know, the FOMC could actually move mix crosses more than the actual dollar mix, since its proximity of the US and the fact that Banxico is really trying to copy paste what the Fed is doing. They already told that they might start to lower the interest rate rises and perhaps even decouple from the Fed, which I think we should understand by doing even less, unless they want to surprise and tap another 50 on top of their already high interest rates. But okay, anyway, the short term 1888 and more medium term, look at this zone. If we start to get bounces up in the 19, keep an eye on what's happening around 1910. It's been a good cap, so watch this zone. Bottom side still in the 1850s. If that goes, then we could really accelerate through 1850 on the dollar mix. What else? Metals, not much to add, especially on silver. It's really trapped in between 22.90 and this 24.45.50. Could move quite a bit today, so watch out if the dollar strengthens. We could see a move down to low 22s, in my opinion, and there I'm going to really start to think quite hard about starting to add to my core again. I think Stel is looking at roughly the same levels, and top side, yeah, 24.5 magic level. If it breaks and holds, we are off to the races, in my opinion. Gold, I don't have anything to say really. We tested the 1900, held. That's your level. Top side, intermediate level 1950. If that would start to go, then we're talking about 1975, 1985 probably. And that's it for me for the time being, unless I'm dollar Noki, right shoulder. Dave, possible? Yes. Where am I? There. Right shoulder, right shoulder. This one? Is it this one you mean?
I think he might be talking about a shorter one. So the
shorter term?
Yeah, so 23rd of the month. So you have the one peaking on the 26th.
This one?
One, yeah.
One.
That's the left shoulder. Maybe, I don't know. Or is it the longer one? Is this the right shoulder and the head is
this one?
I don't know. Actually, it doesn't look
Dave,
very.
Dave, they're struggling. Help them out, mate.
From December.
When it's not this clear, I'm not. I don't think it's that obvious.
Now you know.
Anyway.
Now you know why I don't do it head and shoulders.
Yeah.
That's the one. Very possible.
Thanks, nice one. We'll get you on next week, mate. You can teach these lads what they're talking about.
Come again, Ryan?
I said we'll get Dave on next week. He can teach you about head and shoulders because he can see it clearly.
I don't. Yeah, well, I usually am quite okay on head and shoulders as well, but there's a lot of specialists around now on the shampoo, and since I don't have much hair anymore left, I mean, it's less a case for me.
None of us.
I don't look at it, Simon. I mean, that's something that you perhaps can, or perhaps Ryan can have a look at it if you look at it technically. But I think that's a question rather for the face crew, because they look at nat gas quite actively. Horatio, if the Fed raises by 25 BPs and that's fully priced and they stick to their higher for longer rhetoric, is the market going to believe them, or would the market not buy it and sell off on any knee-jerk move? I think you've just said everything that that the market is thinking about it now. The market just does not want to believe the Fed at any day, really. But the higher for longer rhetoric, I personally think that the market will have to change its view sooner or later. Perhaps not for a full year, or perhaps not even for 6 months, but at least for a quarter or so. Have to push out the the cuts. That's my personal view. So, but is it going to change much to the value of the dollar? I'm not sure, because in the meantime we could have inflation continue to come down, and for me the labor market is going to be, because that's the last big domino still standing. The labor market for me is going to be perhaps more of a clincher than inflation going forward. So I will diverge a little bit opinions from Stel, for instance, who thinks that inflation is still the big mover. I think the labor market could be the one that, if it holds, we will need to revise a little bit the dollar view. If it started to collapse, then the dollar will collapse as well. I hope that replies your question. And with that, I'm going to give it back to you, Ryan.
Thank you very much, mate. Nat gas. Here you go. Here's my view of nat gas. I don't have anything on there. If you're just looking at chart wise, if you're looking for where this thing's going to stop, then you're looking down into the mid twos down here. You know, what I would say about this is, you know, can be reflective of inflation, if you like. You know, we had these big shock moves, and they were a lot behind a lot of the inflation stuff that we saw last year, these big shocking high moves. Obviously, we're coming all the way down. It's going to take time for this move. You know, it's happened really in, you know, the space of a month. So it's not going to be seen in inflation that quickly, or it may be seen in the headline inflation, but it's not going to be seen in the core number, maybe for a good few months yet. But that's the sort of thing you want to be looking for in inflation. But you know, then it gets back to normal. You know, the sort of average that we've seen previously to the pandemic, or through the pandemic, before we got all this. So, you know, does that tell us that prices are going to come down? Yeah, but as we learn in here in the UK, gas prices have come down markedly even in Europe, and my bills are still going up, and bills across Europe are still going up because it's the forward nature of the market. So, you know, trading wise, if I was going to long it, I'll be looking down at that 2.5 level, down to the low twos. But as always, Simon, give us something. What are you looking at? Are you looking to long? Are you short? Are you long and don't know what to do, or what? You know, let us know, and gives us a bit of a better idea. Right, and just something I wanted to highlight to you, boys and girls, if you weren't aware, on the ForexAnalytix site, we do have blog posts. We do have regular updates, analysis, and things like that. And our Wizard of Waves, Gregor, put up a post highlighting some assets and some moves, yields, and stuff going into the FOMC. I will pop the link in the chat room for you. So you can check out some extra analysis, and this is open to everyone. So even if you're not in our chat room on the platform, you can access these blog posts done quite regularly. Stel is a dab hand at them as well. Here's one that I banged out yesterday. Just a quick overview of the central banks, what assets to look at, some of the outcomes I'm expecting or that we may get. So have a look at that too. And just a bit of self-promotion. If you want to hear me waffling on with the good old Michael Brown, which came out yesterday, covering a lot of central banks and some other assets, there's a video there you can crack on into just to have a look at that. And obviously smash that like button, hit that subscribe button. That's what all the YouTubers say, apparently. I think we'll call that a day for today. Thank you very much, Stel, Kay, for your ongoing opinions and views. Always welcome.
Thank you to Ryan and Kay, obviously.
Yeah, both of you. And thank you, obviously, to all our viewers who come here day in, day out, supporting us. Hope we steer you right on what we give in these videos and this webinar. Do trade safe over the Fed. If in doubt, stay out. There's always trading tomorrow. Pick up the pieces. Don't get caught in the middle of anything. Be choosy. Pick your battlegrounds. And I hope you make tons of pips. And we shall find out everything that happened tomorrow morning. Thank you very much.
Bye-bye. Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.